Well, I think it's quite clear that you're looking at what people are calling a synchronized global slowdown. So I think you will see economic slowdown. That's what the IMF data suggests as well. I do think, however, that second quarter was a bit of a cliff. And so even as we started getting into June and into the third quarter, we're seeing some bounce back from a really slow April and May. So I think there will be slowdown, but it might not be as bad as the second quarter data suggests all around. Second quarter is obviously weak for exports, weak for PMIs. Our own sense, though, is that the rest of the year will be somewhat better than that, though on an average it will be slower than it was. Now, a slow Asia still grows at 4-5%, and 4-5% is not inadequate amount of growth in which to be able to build some decent businesses. And that's 4-5% real GDP growth. Yeah. So if you add some inflation and you get 7-8% nominal GDP growth, I think it is still possible to continue to get positive top-line income growth around the region, albeit slower than it was.
Right, but can you continue the run rate on profits that you witnessed thus far into the first two quarters? Last quarter was a record profit quarter for you. Can you better $1.65 Singapore billion really in terms of profits for the second half?
I think we can continue to improve the absolute profit number, yes, because I don't expect negative growth. Right. And so you will see an absolute positive number. The rate of growth will slow down, without a doubt. We grew 12% in the first half of the year. I certainly don't expect to see 12% growth in the second half of the year. But I do expect to see overall full year growth still come in at high single digits.
Okay, and what about loan growth? You have forecasted that loan growth will be in mid-single digits. With the likelihood of a Fed rate cut coming now and perhaps more in the offing, do those numbers get adjusted higher?
I don't think so. I don't think credit demand is being driven a lot today by the level of interest rates.
What is it being driven by?
You'd argue that if rates are lower, people will borrow a lot more. Yeah. I think people's borrowing is really driven today by business confidence. And business investment is generally slow, not because rates have gone up, it's just because confidence is low. So if you have an environment where confidence continues to be slow, I don't see a big pickup in credit demand or borrowing demand.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.